In 2026, experienced investors rarely commit significant capital to a financial platform without first applying a simple but disciplined principle, the small test rule. Rather than relying on reputation, reviews, or feature lists, investors increasingly verify platforms through controlled, low-exposure testing before making any scaling decisions. This approach reflects a broader shift toward infrastructure awareness and operational risk management. As trading environments became faster and more complex, investors learned that platform behavior under real conditions often differs from expectations. Infrastructure risk can outweigh market risk. Early friction is easier to detect with limited exposure. The small test rule is not about profitability, it is about verification. A small test is not symbolic participation. It is a structured evaluation phase designed to answer specific questions about platform behavior. Typically, investors use small tests to observe execution speed and consistency. They also check price alignment with market conditions. System behavior during volatility is crucial to observe. Clarity of operational procedures is essential. Reliability of withdrawals and support responses is a key factor. Capital is intentionally kept limited to ensure decisions remain analytical, not emotional. One of the most important changes in 2026 is the redefinition of trust. Trust is no longer assumed or granted early. It is earned through observable behavior. Investors applying the small test rule do not ask, "Does this platform look credible?" They ask, "How does this platform behave when tested?" Scaling decisions are postponed until the system proves predictable across multiple scenarios. In earlier market cycles, scaling capital often followed early success or confidence. In 2026, scaling is treated as a second-order decision, dependent on repeated execution consistency. Procedural transparency is vital. Absence of operational surprises is necessary. Alignment with broader risk frameworks is crucial. A platform may perform adequately during a test phase and still fail to qualify for scaling if its behavior lacks consistency over time. The small test rule highlights a key investor insight. Infrastructure risk compounds with scale. Small issues that seem negligible at low exposure can become critical when capital increases. Testing early allows investors to identify these issues before they carry systemic consequences. Entrepreneurs and capital managers apply the small test rule naturally because they think in systems, not isolated trades. They prioritize continuity over opportunity. They design for failure resistance, not ideal conditions. This mindset aligns with structured environments that emphasize clarity, predictability, and disciplined execution. The focus is not on promising outcomes, but on supporting controlled decision-making within defined infrastructure limits. The widespread adoption of this rule indicates that investors are more risk-aware. Platform evaluation is becoming more professional. Scaling capital is treated as a strategic act, not a reaction. Markets remain uncertain. Infrastructure should not be. The small test rule reflects a mature investment mindset. Before scaling capital, investors in 2026 test first, observe behavior, verify systems, then decide. Trust follows evidence, not assumptions. In a market shaped by complexity, small tests protect large decisions.